Hello, everybody. I'm Gary Massa with Massa & Associates here in San Diego, California. And today we are talking about investments in apartment buildings and some different strategies here in investments. Again, we've been talking about residential real estate all the time. You hear me talking about, but there's another segment of our business. Many of you may or may not know that we help facilitate investments for a lot of clients in many different ways, right? And right now, there's a lot of people that are out there trying to buy residential assets and knowing that the prices have gone up so much, it almost doesn't make sense anymore. It's hard to get a loan and make the margins over what your costs are to actually get cash flow properties. So unless you're paying cash and parking money, those returns still aren't great. So a couple of years ago, my attention was turned to apartment buildings, right? And I started kind of learning more about it because of a few different reasons, which we'll talk about today. But that experience led me to Corey Peterson of Kahuna Investments out in Arizona. Great man. I partnered with him on a deal that we still work together, and I've learned so much from him. So I've asked Corey to join us for 2 segments today because there's just too much information to plug into one. So Corey, welcome. Please tell us a little bit about yourself and maybe how you got started into apartment buildings.
Yeah, awesome. Thanks, Gary. Thanks for the wonderful introduction. Glad to be on your show and just provide some massive value today. I started off like everybody. I got that once I think gets into real estate is with a dream. And what that dream happened almost 20 years ago. My mom was married to this guy named Bruce. I call him Bruce Wayne. He wasn't Batman, but Bruce was loaded, and he had a home in Hawaii. My girlfriend, now wife of 20 years, she flew with me to Hawaii, and I really met my first mentor. Bruce had a house right on the beach. It was in Kauai. It was beautiful. I remember walking this cove and looking back at his house and said, "What do you do?" Because Bruce had something different, time and money. And he told me the secret. He goes, "I own apartments, and I'm in real estate." And that was all I needed. That was almost 20 years ago. I now own over $95 million plus of apartment buildings across the United States. And I'm living my sunsets and palm trees life as we speak.
That's awesome. Good. That's awesome, man. I love it. So, I mean, again, it sounds wonderful, but I know you work your tail off anyways. You know what I mean? It is what it is. It's just a different type of work. You know what I mean? And so we'll get into that as well. So, I mean, tell us, I guess, kind of getting into now what we're talking about, like the almost the why and outlining the problem, what we were talking about. And what I kind of interluded into is that right now, a lot of people have a lot of my clients that we're finding have owned residential units for quite some time, and they're either tired of dealing with the tenants and all the problems that come along with managing their own properties, or if they have a property manager, like their margins aren't there, so it almost doesn't make it relevant, or they're just tired and they want to have a productive asset without having to put so much time in it, so they can spend the time on the beach, right? Like living the dream, like what we're just talking about. And so that's where I think that apartment buildings comes into it. So Corey, in your opinion, what's kind of the problem, or the investors that are coming to you? What is the solution that apartment buildings are offering to their problems?
Well, I think you hit the nail on the head. Everybody wants some yield. People are looking for a way to not have to do tenants, toilets, and all the frustration that comes into the single family space, right? Because once you decide to do it, and you buy your first home and you find a tenant, and then something goes wrong and that tenant leaves, you are now 100% vacant. And that's really what happens is with apartments, you get scale of and 100 units plus, right? And I think what that leads to as an investor's mindset is, gosh, that seems like that may make sense to me. What I find happens is this, Gary. People come into this business, they want the benefits of real estate, which is income stream coming in. They want the paycheck, right. And they want also the depreciation, the tax benefit. And we get a lot of investors that are just like that, are fed up with the single family game, and they would rather partner and do it more of a passive investment into the right syndicator that's knowing how to take these big assets and drive them to profitability. And it's not super difficult, but there's some things to watch out for and look out for.
Right. So the thing is too, when getting into it, Corey, is like you mentioned a couple of things that resonated for me, right? In terms of as being an investor, I had a duplex, and at one point, and I knew that if I lost like one tenant, the other one would still be paying the mortgage, right? And it's the overage that we were losing, but we wouldn't be completely vacant at one time. So that's a huge aspect of it. But a lot of people like, I know that, we have clients right now that might have bought back in 08 to 12 when there was properties were cheap. They went in, they bought 10, 12, maybe, income properties, and they're pulling their hair out right now being like, I'd never really meant to be my own property manager. And while this sounded like a great idea and they've like kind of struggled with it or figured it out, but after 10 years, they're done with owning all these properties. And so they're trying to figure out where to go with that money. But at the end of the day, a lot of people, like investors, are looking at apartment buildings like, how do I come up with 10 or 12 or $15 million to buy a building like what you're talking about? So then they start looking at maybe a fourplex or sixplex, and it's almost as much work as they were doing.
If not more
is what they were doing in the first place. So tell us about what is a syndication and why that is, a great solution, because I mean, again, an early investor like myself or somebody else can invest 100 or 2 or 5 and not take the whole liability of all the costs, et cetera, on it.
It brings Wall Street to Main Street in a simple terms. What a syndication does. Now, here's cool things about syndications. They are registered, they're monitored by the SEC, so the Security and Exchange Commission. It's not just like the Wild West. We have rules of what we can do and what we cannot do, but it gives the average investor the ability to pool their money with other investors that are looking for the same kind of thing, and then allows someone like me, as the sponsor of that syndication, to go take that power of that money, $3 or $4 or $5 million, and go buy these bigger assets. What the bigger assets give, these 100-unit plus stores, is they give us scale. Instead of having 100 yards to mow, we mow 1 yard. We also have staff, right? We have people that live, that work at our properties each and every day, the leasing agent, the manager, the maintenance guy. These are full-time staff, because apartments to me are like little cities. They're like little factories. Yeah. Right? And they take in rent checks in the form of money every month, and then it goes through a grinding process. And then the back end product is profit for our investors. And so it's a good way to kind of, if you get to that point where you're like, I'm tired of the maintenance, I'm tired of all the things that you have to do. The proper syndication can give you all the benefits of real estate without really all the headache of it, in my opinion. And that's why we chose it as well. For me as the operator, we're also using third-party management companies, right? So we partner. There's just a lot more profit to go around to properly structure something, and even construction management, all the things that you want to do to improve an asset, you can afford when you scale up and get 100+ stores.
Right. So you mentioned 3 things that I want to dive in just a slight bit deeper. But the first thing is, basically like the structure. You mentioned that you're the operator, right? And so I want to understand what that means, or your role in the syndication would be versus the investor, right? You mentioned the scalability, which I kind of want to talk about, those small tweaks that you can make to increase rent by $2,500, like maybe it's just $25, but times 100 is scale, and then how that equals in terms of value, and yep. And then basically like the what that means to the investor, how they do invest in the property.
Sure. So the first part is just the whole structure of what is this syndication. Normally we have what's called A shares. These are our investor shares. They're limited partnership shares of an LLC that actually owns an asset. And then there's also B shares, which is my management group, right? So people that we put together, find a deal. We'll partner with limited partners, and it's typically ranges between $100,000 to $300,000 to $500,000. Seems like that's what the average investment is that comes into this fund. And their role at that point is to, they're going to look at what we call a pitch deck. In other words, we're going to share with them, here's the deal, here's the opportunity, here's what it pays, here's how we think we're going to be able to pay, what's waterfall structure look like? There's usually some money up front as it cash flows, and then there's also some money at the back end when we sell it. They get to share in the profits of all along the way. And it's really not that much more complicated. We just have, management shares, ownership group shares, and then investor shares. And then we come together to do a deal. That's what I love about the syndication model, is most of the times it's structured with, here's this one deal. And I think people can understand that. I've seen also more complicated structures where they're going to buy a tranche or a group of big apartment complexes. But I think most syndicators like me do it on a deal per deal basis. Right. And what I think most investors like about it is usually it's pass or play. They can see if they understand and like that deal, the way it's structured and the payout, then they can go and invest their money in it. Now, the second part you said is, how those little things, how do little changes make a big impact, right? $25. So I'll give you an example of one of our properties. We're doing this. We are having a hard time with doing our getting what we call rent ready units, rent ready. And this is actually on the operation, on the cost side of saving $25, not adding $25, but saving $25. What we found is we were doing carpet. We were paying for carpet cleaning, and the carpet cleaning is $30, $35 per like a 2-bedroom deal. And if you ever watched those types of trucks, they show up at your apartment building, and I swear equipment rolls out real fast. It gets in and goes whoop, 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 and then they roll out, and all of a sudden you see this is like this little bill. It lands on the desk, and they're in it for about 2 minutes. It feels like.
Yeah.
And we go into these units and we're like, did they really clean the carpets? Because they look still kind of dirty, but they gave us a bill. And so here's what we found is that, effort cleans carpet and a little bit of chemical. And so what we found is the right equipment to purchase and buy. We now save about $30 per carpet cleaning that we do on each property. Now, why does that make sense? Well, 30 times 100 is 3,000 times 12 months out of the year at 36,000, right? And we divide that by a 5 cap. That's $720,000 of value that we create by saving $25, right? And then we can put it on the other end of, hey, what if you were to add a microwave on something and charge someone $25, right? Save 25, add 25. Now that's $1.4 million we just created for that value of that asset. To me, that makes good sense. And that's what I love about the apartment industry is that with single family, we're hoping and praying appreciation happens, the market.
Right.
With multifamily and apartments, we can force appreciation by raising the income. That's how we affect the value of our assets. Is not what the market is, it's what the income is. So if we can create more NOI, net operating income, our properties become way more valuable.
And again, just to clarify that's not income, meaning you have to raise the rates, but like you said in the example, the money you save and or raise the rates, right? And so just to kind of add like the strategy here, like when you're out hunting for deals or new opportunities, you're looking for what we call value add, right? And I just kind of want to throw this piece out there is that when you're searching for opportunities, you're looking for those opportunities to either correct the management, save money in the operating costs, and or how can we increase the rent rates on this by fixing up the building or whatever. It doesn't necessarily have to be one or the other. It can be a combination of all three. But I mean, I don't know, do you have another story or like example that you can share on like what the value add aspect is when you're from a start to a finish of a deal, like if it was a textbook?
Yeah, we can do it just with the deal that you're invested in, Gary, right? So yeah. That was a great case study because we came into that deal and it had a problem. One of the first problems was bad management. Okay, it was being operated by a Section 8 type of management company, affordable housing, and we were a market rent property. So there's a different mentality in how you manage that asset. And so it was the wrong management company and management style. Right. But the biggest problem was that they were renting to corporate units. This is in Yuma, Arizona, and there was a lot of corporate tenants like Farm Fresh. Everybody, if you guys know anything about Yuma, Yuma is one of the agricultural hubs in the United States. And
Right.
there's migrant workers that come in for about 9 months out of the year. And so these corporations like Farm Fresh would rent our units, and they were like, I don't know, 40 or 50% of our tenant base.
Right.
But what happened was at the end of that 9 months, they leave. So 4 months or 5 months out of the year, our property went from like hero to zero. And it was that disparity in income, that fluctuation is hard to budget for. So that was the first problem. We said, hey, can we just fix the income stream? And so that's what we did on that asset is we looked around at the marketplace and said, is there enough people in this city? Is there enough businesses and jobs? Can we go find regular tenants that just want to live in a nice place? And the answer was yes. And so effectively, we did that in about a year, Gary. It took us about a year to fix all those tenants just by leveling out the income. Now banks found us more favorable, and it had a way more steady story. The second part that we did is we're starting to renovate the units. The first part was just cleaning up all the deferred stuff. We were just fixing all the brokenness. We are doing it right now where we're adding, going into this property where we have, we're putting hard new countertops, new cabinets, new flooring, and a new paint scheme, right, to make it more modern. And we're finding that people are willing, like we've got one, we've not even finished the project. We already have it leased out for $175 more a month on rent. And that's 152 doors, right, that we're probably going to do it that way. And so that yields a tremendous benefit. And so it's fixable problems. And what we really look for, Gary, is broken management and broken properties, like things that are not fixed that need fixing. And then can we add new stuff to really increase the value and really force that appreciation?
Exactly. So, I mean, again, just that was real quick peek into what our next segment's going to be as well. Like, we're going to dive into that transaction as a case study.
I'm sorry, I jumped.
No,
I jumped in.
It's totally okay, and it's perfect because it is a little taste of what we're going to go into a little bit more deeper. Because again, this is a complex. It's easy to understand and simple, but there's more complex information about it that more people will want to know, right? But the example part that I was trying to get across to everybody at this stage, of our series here is that, it's not about just buying a building at what looks to be a good deal and hope that appreciation goes up and you get cash flow. There's a distinctive strategy to it and different opportunities to be able to make money on the monthly rents on the cash flow and B, increase the building at the end. And that's why you're so good at what you do, because you understand that. And when you're hunting for the deals, that's what you're looking for, right? Every
property has a recipe, Gary, right? Yeah. And that's really, we're like, what's the recipe? What does this one take to make it yield the right stuff, right? And can we do it? And how much time is it going to take for us to do it? And how much money will it take? And then after we do all that stuff, does it still make sense to be a green light project?
Yeah, exactly. So, I mean, that you mentioned one thing that brings us up to like the next question, but I was asking or wanted to talk about, the benefits to the investor. We talked about cash flow, immediate cash, or like monthly cash flow or quarterly cash flow, as well as what's on the backside, but also well,
let's even talk about that for just a little bit more, Gary. So think about this, right? So this is what I've realized. I come from I used to be a financial advisor, and I always think about like what people have, what investments do they have, and what does it do, right? And when we get into closer to retirement, I think what most of us really, really want is steady paychecks. Right. And what I found is that the market is very illiquid in doing that. Like stocks, bonds, and mutual funds, that's like the roller coaster. Yeah, and I think that's what people are scared as. It is. No, there's no rhyme or reason of how it works. Unless you're an institutional grade investor, the little guys like us get squashed. And so what people want more than ever is just consistency and an income stream. But then they also have the other biggest fear is inflation. Is how long am I going to live, and am I going to outlive my money? And so I think that's why I love the apartment side of things, because it can give the income stream a little bit, but also it's that back end side that when we sell these properties, we typically hold them for 5 years. Most syndicators will hold things. It takes a little time to fix them, and then you want them to operate really smooth for 3 or 4 years. Then you can sell it for a lot of profit. When you do that, the investors get that other windfall of money, and that's usually the money that they'll take and reinvest, and it gives them a rising income to keep up with inflation because it's real.
Right. And you answered another question I was going to ask, what the timing of these investments were. Like we've been talking about, 3, 5, 7 years, typically somewhere in that neighborhood, right? But it's not typically like a forever investment. They're typically termed out, right? And then you invest into another opportunity. So it's not like your money as the investor is being tied up forever.
You get to see your money, right?
Yeah.
So, and you get to get it back. Listen, think about this. So what other options are out there? CDs, 1 year, 3 year, 5 year CDs. That's, people are used to that already. And ours is usually 3 to 5 year holds, right? But if you go to bonds, if you're going to go buy a bond, bonds are usually 20-year bonds. If you buy a true bond, and like, that's a long time not to go visit your money.
Yeah,
right.
Exactly.
And so that's what I like the structure. It's usually between 3 and 5 years on average, more so for us on the 5-year side. We like to buy and hold and operate more, but that way we have a clear exit strategy in that 5th year. Right. And then, but people like to, get income along the way, but they really like to visit their big, large pool of money every once in a while. Right.
That's right. And they want that back to do. I mean, a lot can happen in 5 years, right?
Well, life events happen too.
Yeah.
Right. And so here's the other part that I love about the syndication model is normally you're locked into a deal for about a year. And, in other words, you can't sell your shares for 1 year when you first get them. But after that, you can. So if you have a life event, this happens to us in our syndications a lot, where I'll get a call from an investor say, Corey, man, I've got somebody died and we need the money. We need it, not sometimes all of it or just a portion of it. So what I'll do is I'll help facilitate, because we have lots of other investors, and say, hey, yeah, they'll take your position and then facilitate that exchange so they can get their money back. And so there's still some flexibility, right, even in this model, that I don't think is as much in other cases. So I think it's good.
Yeah, no, I mean, it's an awesome opportunity, which is why we're talking about. I mean, again, it's one strategy, but I feel like a very great strategy. Especially that it's available to a lot of different people. And the next question is, like, who can take advantage of these, of this investment model? It's not for everybody, right? But again, it does appeal to a lot of people, and who would kind of qualify for this, because there are laws and limitations on.
Yeah. So we have a process. So in most of our deals, we do what's called a 506B offering. It means we can accept accredited investors and non-accredited investors. But the non-accredited investors, just so you know, everybody knows what an accredited investor is. It's someone that makes either over $250,000 a year or has a net worth of $1 million, excluding their primary residence. Okay. So if you're not that, then you're non-accredited. And the way we can have a non-accredited person come in is we have to have a relationship. We have to ask you financial questions, right? And usually there's a little form that we get to fill out with those types of people. And then we're going to kind of vet them, because even though we have an offering and they said, hey, I'm interested, my job is still to make sure as the sponsor that this is the right suitability for you. So I have a little bit of fiduciary in that, in that role. And so not everybody can get it, and not everybody should. If it's your last $25,000, $50,000, and this leads into a kind of, probably, I don't know if you have it on our notes here, but what is the average investment size? Yeah. We've raised ours to 100,000. That's not to say that we wouldn't accept 50, but most people will come in at a $100,000 range on their first try, and then after they've experienced, the experience, because it's new. If you've never done a syndication investment, you got to want to see how it works. And then after you get a comfort level, what usually happens is we start getting lots of bigger pools of capital from that original investor, right? But between 50 and 100 is really what the average syndicator will come in with. Right, exactly. So, I mean, again, you mentioned a couple really good points too. It's like,
first off, the business that you're developing, right, is more long-term. You have investors that have been with you for a really, really long time. And there's a reason why, because they trust you and, you know what you're doing, and people then tend to add to that. But again, you have a fiduciary to the person coming in, right? Who, just to make sure, like, hey, look, this may not be the right investment for you, and I'll be the first to tell you. But also, you have a fiduciary to the rest of the people in your group, right? The rest of the investors as a whole, because you can't have somebody come in that might not be, stable in the sense that it may need to take their money in and out. Again, it's fluid, like we talked about. But at the end of the day, typically we want people to stay in the syndications,
Yeah, you want them to stay in for, and most people will, right? So, and there's always a few occasions where it's a life event. Those happen, but but not the ones, so it is a vetting process. The other part of that is that what I love about the way syndications are structured is there are rules. So I create this document called the Private Placement Memorandum, and it is my guidebook. It tells me who gets paid first, who gets paid second, when can I get paid, when does all the things, all the pieces. It is like the Bible. And if I don't follow it correctly, I can go to the pokey. And Gary, I don't look good in orange.
Yeah, so, I understand. So, I like the Hawaiian shirts better.
Yeah, and so like we have a high respect for doing things right, as I think most good syndicators will. The real question is, how do you vet a syndicator, and how do you vet a deal?
Yeah. I mean, these are good questions. Maybe we can dive in on that, like, in our case study of how to really look for these, even as the investor, or what you're doing. But like, one question that I wanted to ask you now, I think we've got a really good understanding about what the syndication is, right? Yep. And how that works. Obviously, people are probably going to have a lot more questions, and I'm really hoping people will come in and ask those questions. Maybe we even have some comments at this point. Oh, Jeremy Henley says, "What's up, Corey?" So he's watching right now. My good man, Jeremy Henley. Good to see you, man. Thanks for watching. So the last question that I wanted to get into real quick for those watching is kind of like the market. Like, where do you see apartment investing and investments going in the next 2 to 5 to 10 years? And the second part of that question is, how has COVID impacted that market more immediately and on the long term? Because a lot of us just watched, over the last year, a lot of tenants not pay their rents and not have to pay their rents, which put a lot of landlords in a hard spot. So where does that leave apartment owners and investors like this?
Yeah. So listen, my outlook on 2 to 5 years is actually really promising, and for the reason of this. Like, so I think there's a lot of new investors that were in single family residence that maybe jumped into apartments, maybe not quite prepared. And they probably bought and overpaid for some things. And this is coming. This is actually, because COVID's been around we're on our year anniversary, right? Right. So a lot of those guys that were new in the business, maybe underfunded a little bit, didn't quite have the right model, didn't have the right team. We are starting to see little things happening where, short sales or maybe pre-foreclosures. There's deals that are going kind of south. As for me, that's a good thing, because I'm going to be able to probably buy some what I call micro repositionings. And these are probably really good deals that other investors bought, but they were just new and they weren't well capitalized. And then because those COVID, I mean, listen, everybody took a small hit of somewhat. Now, some more than others. Like on the Palms, we didn't get hit at all, right? As far as a slowdown. But I've got another property in New Orleans that we had 20% not paying for like 3 or 4 months. And so, but luckily we were well capitalized that we managed through that. But there's a lot of other people that are not. So I think that there's going to be some opportunities. The other side of that, so bad operators or new operators creates opportunities. But on the other side of COVID, just as the economy side is going on right now, inflation is coming. And look at home values. It is hard. it's getting harder and harder to buy homes, even though everybody's doing it. That's going to create a lot of, we are still affordable housing, B and C class assets. I don't buy the Taj Mahal brand new build property. I buy 1980s, 1970s product, some 2000 product, but not 2020. And
Right.
so these are all affordable. And that is not going away, my friend. In fact, people are, if they can't buy a home, what are they doing? They're renting. And where are they going to rent? From a great place like mine. And
Right.
and there's more and more, the middle class is getting squeezed right now. And so I think having affordable housing is the ticket. And right now we're in an inflationary period. And I feel like that's what's going to continue the growth. And listen, it's a little nerve-wracking to see it happen. Like it's happening right now. Look at gas prices.
Yeah.
It's going to keep happening, and it's going to be slow, but we are starting to raise rents more than we would normally raise them because that's what the market's giving us. And I think there's going to be a lot more than that. So I'm actually pretty bullish on the apartment side right now. I'm being cautiously optimistic, but I know there's deals, and like we're not under contract, we're close on a bank-owned property that's student housing. $24 million. It's in receivership that we're getting ready to buy. Those deals are out there. They're coming. There's more and more of those little deals trickling. And it's going to be a little window about, I think in the next year window is going to be some really good stuff to buy. But long-term, it just, as apartments go on, it's a great marketplace.
Yeah, no, totally understandable. And again, I mean, I agree with you 100%. I'm seeing it in the residential world. Like right now, our property prices are compounding. And I know that there's a good portion of people that just have not been able to pay their mortgage and or their rents or whatever the case that are going to need to make a decision in terms of like finding different sort of housing, whether California, Arizona. We just did a segment interviewing residential real estate broker that I know well in Arizona about the migration from California, Arizona. And again, so people are going everywhere, right? Switching out of their homes to apartments or whatever the case. But like you said, that I fully believe in is that, we're not trying to swing for the grand slam fences here and try to, get the highest price property in the best area. It's something that the general, your renter pool will be large, right? So then you'll always have renters. The price point will always be there. It's a very steady, long-term, consistent asset.
Yeah, this is what I love. This is what I love about B and C properties, Gary, is think about this. The market economy tanks for some reason. Anybody, renters, I would say, are still renters no matter where they're renting from. And so if economy gets soft, everybody that was in the Taj Mahal, that brand new build, they're like, gosh, I can't afford this. They're still renters. What are they going to do? They're going to come to my place, right?
Right.
So when the economy goes down, I have downward pressure of good tenants, probably better scoring tenants, going to move into my property. As the economy is going up, I've always, if I'm doing my properties right, there's always a group of the best tenants in that B or C class that wants the nicest, cleanest, best managed asset in that asset class. So there's always people that are moving to it as well that are, I'm now ready to move into something that's affordable. And if you can give them clean, efficient, and disciplined properties, that is the recipe for success. Clean, efficient, and disciplined. Disciplined is no smoking or joking in the breezeways, clean, lit up like a Christmas tree at night, safety,
Safe,
security cameras, right? In these B and C class properties, which, a lot of these things don't have that infrastructure. So we bring it to it. And then A-class management. So you want to feel like you're at the Taj Mahal, as far as people, but you don't have to be in it.
Right. And paying the price. I mean, all super great points. So, all right, Corey, we just hit like 30 minutes, man. This is so much great information. And I know we're going to continue this next Wednesday at the same time. We're going to actually go into the building that we were just talking about as a case study to try to understand like how it works, the inner workings of of one of these investments, what to expect, the why, the how, all the good, bad, and the ugly. I mean, again, nothing's always perfect or pretty. So we'll talk about all those good things so people can really understand, because in the point that I'm trying to do right now is help people understand that there are investment opportunities out there. And if they're ready to start taking control of their financial future, it's time to start learning about the different opportunities. Maybe syndication isn't right for them or whatever the case. But the point is, start learning about it, understanding it, because like you said, coming out of 2004, 5, 6, when property values went through the roof and it was the greatest real estate market ever. Again, different time and different fundamentals why it crashed. And I'm not suggesting we're having a crash in the market, but with every up, there's always some sort of, correction, right? In a sense, the point is to be ready when that happens, right? And so it's time to start learning about it now. So when the right time comes, you can take advantage of it.
And here's the other part of that. I'll tell you this is what I've learned, and because coming from a financial advisor's background, I've watched, 12% steady is different than an average of 12% on a roller coaster.
That's right.
And because it's really not the same, it always yields more with nice and steady is what I found. And the stock market is just one of those crazy things. And when we think about investing money, I truly believe that real estate in some way, shape, or form, whether it's the single family way or getting into syndication, I believe it gives us the best vehicle to grow our wealth and where you can actually be in control. Because the stock market, there's no rhyme or reason. People would, give me money, and then in 2008, half of it went away, just like that, for no rhyme or reason. And those people that were in retirement, gosh dang, I feel so bad for them because they're probably never recovered. And so taking control of your own destiny now, I think is more smarter than ever because it is needed more than ever.
Yeah, I totally 100% agree with you, Corey. So again, thanks for your time right now. And just to say thank you for the people that joined us and added comments. Jeremy, Danielle, Debbie, and Sarah, really appreciate you guys adding comments. Again, if anyone has any questions and didn't get them answered during this particular segment right now, please just list them below, make your comments below. Corey will be happy to answer them. Again, Corey is all about education. He's a best-selling author. And again, it's just because I know that your heart is big and you want to help people understand how they can take control of their lives just like you did. So again, Corey, thank you. We'll see you next Wednesday, same time, same place.
Rock and roll, brother.
See you later, man. Thank you.